Ladies and gentlemen, please welcome Scopelitis partners Greg Feary and Jay Robinson and the financial and investment panel guest presenters John Anderson, partner, Greenbrier Equity Group, Steve Lodowick, CLO and EVP, Lantner Delivery System, and Spencer Tenney, President and CEO, the Tenney Group.
Here we go again. Similarly to the lunch panel, I've been lucky enough to know these gentlemen for a number of years. John, probably longest. That may be evident by
That's because I'm the oldest.
Well, and because I am too. But I'm honored to call all of them friends, except for Jay. He's a friend. I'm just not as honored to. All seriousness, these are top guys, and when we talk about financial and investment panel, it's a little bit of an overlap on Jay's M&A panel in that there are a number of similar perspectives that you have when dealing with the financial and investment world. John Anderson, operating partner at Greenbrier, investing in lots of transportation businesses. And John, you're going to have to remind me, you guys just got one of the most prestigious awards given in the private equity sector. What was that?
Well, it was looking at, there's a consulting firm that analyzes 10-year returns for kind of middle market private equity firms. And so we were the top firm in the world in terms of the returns we provided for investors the last 10 years.
That's awesome.
Yeah.
And Steve Lodowick is Chief Legal Officer and EVP, even has ownership interest in Lantner Delivery Systems, and sees financial investment issues from the chair of a general counsel. And Spencer Tenney, President and CEO. We've known his dad Charles, and then Spencer. The Tenney Group is considered one of the top business transportation brokers in the United States. So we're lucky to have them, and I'm going to start right with you, Spencer. We've seen actually quite a bit of activity in 2023 leading into 2024, the last 18 months. Talk a little bit about that acquisition investment activity that's going on in transportation.
Yeah, I think it's just to provide some context. I think what we're not seeing and probably won't see even for the next year is these large industry-shaping transformational type deals. But still, there's a tremendous amount of activity and engagement despite some of these headwinds in the marketplace, be it cost of capital, the freight market, the equipment market. We could go on, right? I mean, but it's actually because of that pain that you're seeing sellers that perhaps business owners without successors that maybe wanted to exit in 2020, but then kind of got caught up in this cycle the last several years. It was either too good to sell or it was too covered up to consider exiting at that point. But now what we're seeing is not an ideal market, but certainly a much more stable environment than we saw 6 to 12 months ago for those folks to go advocate for their own interest through a sale. And then at the same time, many buyers, primarily strategics that don't have a lot of options to offset the increase in expenses. I think ATRI put a number to this last year, the average increase in cost per mile per truck at 21.3%. So that's not something that you can absorb or that you can offset organically. So tremendous amount of, and we've seen this across certain verticals in bulk. You've seen CAG, you've seen Quanix, you've seen TriMag, and variations of that in other verticals, but leaning in hard to grow through smaller, lower market type deals that are accretive, but also provide some level of insulation and specialization, niche expertise. And so I think that we're highly encouraged, just in terms of top 5 verticals that we would say that are probably getting the most engagement, that buyers are coming to us looking for. I would probably say the bulk, as I just mentioned, specialty brokerage firms. We have a couple that are going under contracts this month, high interest in those. final mile, dedicated, and then probably lastly, warehousing. And so those all, I think, have some element of response and risk mitigation as part of their growth strategy. But again, I think we're very encouraged by the amount of people at the table. I think that the one primary theme associated with all these deals is that we're seeing a tremendous amount of structure being used to align goals for both buyers and sellers. I think some sellers hear that as negative, but I would challenge that because I think that's an instrument for sellers to actually expand the scope of their total consideration. And I think what the key is to the seller and their advisors to thoughtfully scope what that earn-out package or seller note or roll forward equity, whatever it's going to be, to bridge that gap. Because the reality is, in the current credit market, there's some shortfalls to kind of put together the available capital to get these deals done. So I'm encouraged by the levity and the open-mindedness that we're seeing both from buyers and sellers to get deals done in this environment.
Greg, I might just jump in and say I can hear what Spencer's saying. From our point of view as a private equity firm, and probably the largest investor in kind of middle market transportation logistics, we're just not seeing it yet. Yeah. We could see no deals this year of size in our space that we can do, and part of it's capital availability, part of it's just price mismatch between buyers and sellers. But I think we're lagging the buyers and sellers Spencer is seeing in terms of just the size of deal we're looking at. It will be, our view so far is a real dry year. Whether it's selling, for us selling, we have a lot of companies that are ripe and we'd like to sell them. Buyers aren't going to step up, and buying, we could buy no companies this year.
Yeah.
John, could you just, for context, like just what is your kind of sweet spot so there's some context?
Yeah. We're a $3.5 billion fund, so we'd like to do deals where the total enterprise value is 500 to $1 billion for the enterprise, and then so we'd be writing an equity check of 250 to 500 million.
So the bigger strata, it's not coming.
It's just not moving. You know, there'll be a deal done every now and then, but it's a fraction of what it was 3 years ago.
Yeah, agreed 100% on that.
Yeah.
You know, further to that point, John, when I first started doing transportation transactions, they were invariably strategic transactions. I mean, in private equity was pretty late to the game in transportation, in my view. And when you guys came to the game, it was asset light, right? No one wanted to do an asset heavy deal. Really, up until COVID, that dynamic had changed, and we were doing a lot more deals involving private equity, whether it was the first investment or the bolt-on acquisitions. Private equity was becoming very active, and then it dried up again during COVID and really hasn't reemerged to anything near what it was before. But most of those deals are closely held companies, and it's always an interesting dynamic for me as private equity comes in and starts analyzing financially and operationally this closely held company, what that experience is like for the closely held business owner. I was wondering if you could talk for the group, what do you see private equity bringing to the table for a business owner who sells their business and likely retains a portion of the go-forward enterprise?
Sure. Yeah, Spencer said that's more and more common, that we'll basically require of a seller that they'll roll over some of that equity. I was mentioning this morning, we'll have people, we might have a seller, if there's a family, we might be basically paying them $200, $300, $400 million, and we'll require half of that, or certainly after tax half, to be rolled back into the company. So we're aligned that they stay involved and so forth. And I think the deals that are getting done now from a private equity point of view are deals where the sellers are not maybe as happy with the selling price as they would have been 3 years ago at a peak, but we're willing to pay them up to that price on the come. So in the COVID days when so many segments were booming, private equity like us still had a lower cost of capital. We would be willing to come in and we'd be willing to pay a relatively high price and buying for that growth before the real COVID bump started.
Yeah.
Then as the COVID bump, where people doubled or tripled their earnings, we had to say as a buyer, wow, we're not going to count on that being the same for the next 5 years as we're holding the company. So we can't pay that much. Or if you want us to pay a pretty high price because you say you're going to grow, and we think you probably will, you better retain a lot of that, and we'll pay a price we'd like to pay right now. And then if that comes true, you get another check for $250 million. Mm-hmm. And so that's how we're structuring a lot more of them now.
Steve, I'm going to ask, Steve's in a unique position as the general counsel of a company that has a lot of reach across the United States. They're primarily in auto parts overnight delivery, but their tentacles go out in a lot of different directions. And Steve has to manage expectations and lawyers and how the process goes. You want to talk about all the layers that you're worried about on the buy side of a transaction?
Yeah, sure. With the caption being financial investment, I think from the buy side first, you're getting into this transaction because you've got an investment thesis. And so a good part of what you're doing before the transaction closes is, of course, trying to prove out that investment thesis and make sure you're setting up the company to really get that value that you're going after if you're able to close. And I think one of the places that you definitely want to focus on, of course, is the customers, right? As a buyer, we want to get as much information we can about those customers as soon as we can. And although the sellers may not be too anxious about that off the onset, and information is going to kind of be doled out, as conversations progress. From the buyer side, we want to get that feel for that customer relationship. What is the likelihood of us retaining that customer? Is the seller performing well? That can go a couple of different ways. Post-closing, we could be coming in to fix something, or we could be hopping onto a strained relationship. And speaking of those relationships, I guess we want to get a good feel for the relationship between the seller and the customer's business contacts. Sometimes those actual day-to-day contacts can end up having some influence on that go-forward relationship. So it's good to kind of feel that out. And we also want to get a look at the customer contracts themselves, or maybe change of control provisions in there, or may just be a notice, may be completely silent. But really, understanding the risk of losing that customer is going to be a big point to that. And I guess finally, on that customer point, it's kind of some respects a small industry. Word gets out that there is potentially going to be a transaction. You've got other competitors that can maybe try to, be opportunistic in that regard. But I guess that's the point of the next piece, I guess, which would be the NDA. And of course, before this information starts flowing, there's got to be an NDA in place. And the things that we're looking at, no different than any other NDA for a non-M&A transaction, obviously the scope of the protected information and what exceptions there may be to that, the term or duration of that NDA. But here, you'll be putting together a deal team, and so you need to also consider who else do you need to be able to share this information with as you're evaluating the deal. And so, of course, your lawyers, that's kind of a common one. But, you may have financial advisors. Maybe there's going to be a quality of earnings performed. Maybe there's some specific assets that you want to engage consultants to take a look at. Maybe your insurance brokers to see how their plans fit into yours. So that's a point to cover as well in these NDAs that's maybe unique from some others. And then finally, you'll often run into non-solicit provisions for employees and customers. And so there's going to be, obviously, between the buyer and the seller, different points there. But those are some of the NDA pieces. Once you've got the NDA in place and your diligence is really underway, we're really trying to keep the full diligence team together. It's helpful to have your diligence list laid out ahead of time, who's going to be responsible for what, and how far that's going to go down into your business, because again, this is confidential, the transaction is confidential, so there's always the opportunity to remind folks that the reason that you're allowed to have access to this information, what you're allowed to use it for, and what you're not allowed to use it for. And when you're going through that diligence process, getting questions from answered and information from the sellers. On the seller side, they're also going to be working on their disclosure schedules. And it's a good opportunity to take those disclosure schedules and use them to validate the information you're collecting during your diligence, make sure that they're lining up, and ultimately, all during this process, you're working towards some sort of a definitive agreement. Along that way, likely going to run into an LOI or indication of interest, some sort of term sheet. And the points in those that I think kind of straddle the business and legal part is, of course, you've got the economic terms, how you're looking at valuing the company or the assets. Some points that these gentlemen brought up about, whether there's going to be a seller's note or the seller's going to roll any equity in play, whether there's going to be an earnout, how far out that earnout period is going to be. Back to kind of the customer contract piece, kind of working into closing conditions. If there is a customer contract that's at risk, or there's a renewal that's kind of not lining up with this process, you may include closing conditions that revolve around retaining that customer or renewing that contract. And then you get into some of the more traditional things that I guess you'd expect to have in any deal, the reps and warranties, whether those are going to be just fundamental reps and warranties, to what extent, what's the look-back period going to be. You'll get into your discussions over your indemnification obligations, whether it's baskets, caps, et cetera. And that can kind of bog things down. So, we've looked often to representational warranty insurance to kind of bridge that gap and bring the deal together. That also, in some respects, help you negotiate what those reps and warranties and indemnity provisions are going to be.
Spencer, working with your group over the years, I would say one of the hallmarks of a Tenney deal is the prep work you put in with your clients, preparing them for sale. John touched on it. Valuations are, and we touched on it during our earlier panel, valuations are really tough. But right now, just given the different economic environment and how a look-back formula might work. But in your case, what are some of the key expectations you look at needing to set, some of the key issues you deal with in preparing your clients for sale?
Well, I think it's a great point. I think what we don't do is we don't limit it to just the value of the business itself. I think that's a very limited way for business owners to make very thoughtful, generational type decisions. And so what we're trying to do is, yes, we want to help educate business owners, but we want to do this in a way that allows them to perform during a transaction process at a very elite level. And so what we've known in terms of like the characteristics of preparation that have allowed business owners to execute in that manner are these. Number one, like the pre-valuation understanding about how the market's likely going to respond to their business, not only in terms of the top line, but the likely deal structures based on the inherent risk of transferring ownership of the business. There's a lot of rumors, and people will talk about structure around the deal, but once a business owner understands why it's there, either because of customer concentration or because of some earnings volatility, then they're more likely to be able to see the business from the buyer's standpoint and understand the importance of sharing some risk as part of maximizing. But without the education in terms of the context, you just say the value. That's a very limited way to educate the business owner. But the other part about it is, in our process, it's, okay, here's what it is today. What could we do over the next 12 to 18 months to enhance the value of the business? And that's a very important question for people to kind of actually engage into the process, because oftentimes our firm will say, like, if everything works out, like, how will the business be different? And then the second part of that is, what will be required of you to actually go affect that? And oftentimes what we learn is that the buyer knows exactly what could be done, but has absolutely no interest in executing on that. And so the reason why we want to make sure that we go through that step, well, number one, if there's still some fuel in the tank and they want to go execute that, there's an alignment there. We'd rather sell the business another 18 months from now and earn a higher fee. But until that they've understood and realized that, okay, what's required to enhance the outcome, I'm not willing to do. So that this automatically gets us in a place where we're going to be more collaborative in the process to enhance outcomes. And then the other part about that is we have to get multiple offers, and I'm sure John can, appreciate this, is because if the seller has only seen one offer, even if it's a fantastic offer, there's really, outside of an advisor like me, he's not going to take my word for it. There has to be a real context for them to appreciate that. So when you have the pre-education and then you actually have the holistic approach about not only after tax, what are you going to do in terms of asset management post-transaction, people get pretty excited about, okay, so you're saying that I can still get a return on my capital and I don't have to have nuclear verdicts hanging over my head? Okay, I feel a little better about that. So we're doing all those things, and then they get multiple offers. It's just much easier for the business owner to lean in and work collaboratively to advocate for their own interest at that point because they're confident. I think that's the key. Like what we're trying to do is to create confidence through the education. And when business owners in this industry have confidence, look out.
Yep.
John, you'd mentioned this just a few minutes ago, but it strikes me that private equity coming in can be pretty intimidating. You've already said, hey, I expect some rollover. I expect them to hang in there and work shoulder to shoulder with us. But what are some of the things that you have to diffuse when you're walking into a circumstance where someone would rather, frankly, have a strategic buyer than a PE firm, because these are guys that are all about the money, and I'm not sure they know much about trucking, and gosh, they certainly don't know about my trucking company. It seems like it would be an intimidation factor that you've got to deal with.
Well, I think you're right, and there's a lot of reputation that comes along with private equity firms, and some good, some not so good. And from the buyer side, as we go in, it may look intimidating to the seller, but we have to basically have delusions of adequacy or competence, I guess, to go in and do what we do. I think that you made an interesting comment. I would say most sellers that I know of would rather sell to a private equity firm that they gain some trust in and over the process get to know and think that might be a good partnership rather than a strategic. When a strategic buys a company, most sellers would have seen situations where a strategic comes in, sorry that your name's gone, we're rebranding it, sorry I've got my guys already lined up to come take over, sorry your family members are going to have to go. And that feels worse to a lot of sellers who are individual proprietors, and especially if they've been very successful. So I would say a lot of the sellers I meet and deal with, even of large companies, but large private company, they're more interested in trying to maintain their legacy and so forth. So what we have to prove to them is that we aren't one of the bad PE firms. We don't have that reputation, or put another way, that's not how we're going to make our money. Because that is a way to make your money. Buy a company, strip it down, and do exactly what your formula says you do, and we come in and take over and so forth. That's not the approach of a lot of private equity firms, and certainly not of Greenbrier. So our job is to understand an industry well enough. We bought trucking companies for 25 years now, so we understand them pretty well. But then it's to convince that seller that we could do this as a partnership, and why don't you roll some money in, or you're going to have to roll some money in to make this work. And so we've got to partner up. There's a proverb in Africa that came out. I always kind of like, if you want to go fast, go alone. If you want to go far, go together. And we try and do that. I mean, we want these companies to grow rapidly. We want them to be profitable. We want them to be better companies when we go to sell them. And so one of our jobs, and certainly one of my jobs, is convincing companies that we have experience in this business. We bring skills that most private trucking companies don't have, which are in the areas of doing more acquisitions, in the areas of financing the company appropriately. But we also have to convince them that we aren't going to try and run your trucking company. That's not our job. And we liberally use CEO references from companies we've owned and exited from in the past. So there's no connection anymore. But talk to these three companies that we have bought and sold in the past. Ask them how we did. What do you think of us? And so that's kind of what we're looking to do. We bring the skills we bring that most private companies haven't got a lot of experience in. and we bring an approach to oversight of the company that's not going to try and tell you how to run the company, how to price your company, how to deal with the competitors, and so forth.
So Steve, you guys have closed a number of strategic deals over the years, and similarly, our last panel, one of the questions was, what are the big issues on assimilating a company post-acquisition? In your experience, what would you say the big issues are that you deal with?
Sure, yeah, I mean, the celebration is brief of the closing because you've got to get back to normal work, and so I'd say back to managing that customer relationship, it's kind of an all-hands thing to make sure that you've onboarded that customer through the transition and that they're, really getting the white glove service, to make sure that you're cementing that connection that was made. So folks getting in front of the customers and making sure that you knock down issues, especially quick as they get stood up in the first couple days after the transaction or a period of time. Employee integration is a big point too. Often there's synergies, so maybe in the back office, so maybe a lot of those folks aren't coming, but there's still a lot of kind of balls that could be dropped during that transition. But getting out to the frontline workers or the drivers, making sure that they feel welcome and that they're onboarded, part of the family. Dealing through any of those issues. A lot of folks don't like change, so just sort of reassuring there. We end up spending a lot of time and effort on that. And then depending on the transaction was structured, now if there was earnouts, as been talked about here, then make sure that we're measuring the right things and that we're following that formula or what was been negotiated and agreed to really be on the same page early on, kind of from the onset during that measurement period, so that we're ready to kind of report and negotiate as necessary. And then, maybe if the seller didn't roll any equity in, or maybe even if they did, often there's consulting agreements that are used, and that can be whether it was just a vehicle to get the seller principal some more money, or maybe you really want to make sure that you've got their help in onboarding customers and transitioning, et cetera. Kind of keeping tabs on that is important, because especially if it's a founder, they started this business, they're used to driving the bus, and now they're a passenger on the bus. That's just a close thing to monitor and make sure that you navigate. So.
Awesome. Well, we're reaching the conclusion of our program, and we want to thank John. Spent 6 more hours in an airport than he really expected to. That's why we moved this panel a little later. So thanks for sticking in there, John. And
I would have been surprised and really irritated, but I did read Delta unveil their new corporate slogan last week.
Which is what?
We're not happy till you're not happy.
Thank you, everyone, for your patience.